Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas President and Head of Portfolio Strategy, Nicholas Bohnsack, to talk all things markets. Nick, how are you doing today?
I'm doing great, my friends. Good to chat with you again.
Great to have you on. Really opportune moment to talk to you. We've had Fed Chair Powell speaking in front of Congress over the past couple of days. We have a lot of data this week and next week. So I think it's a really good time to check in with you all on how you're thinking about inflation and what his comments might mean for the ultimate path of interest rates over the coming year and maybe years to come.
Yeah, I think that's absolutely the right starting point. What's been interesting to us really over the last, I guess, we're into March now, so that's 2 months plus, is this sort of gnawing disconnect between the economy, which I think most people sort of conclude that at some point is going to come under some pressure and may even slide into contraction over the next year or so on the one hand, and on the other, sort of the resident strength in risk assets, equities in particular. And what strikes us interesting is that most of that strength seems to be predicated on this idea that policymakers, the Federal Reserve in particular, are going to pause. For a while it was they were going to pivot, but I think pause. And now, to the extent to which inflation has remained as stubbornly high as it's been, the chairman has taken sort of revisited some more hawkishness, particularly after Lyle Brainerd left for the White House. So the idea that 50 basis points for the next meeting is back on the table suggests the terminal rate could be, somewhat higher than perhaps was previously being considered. And I think that the final sort of point of consideration is, just what concessions are the Fed willing to extract from the economy in order to get inflation back down to a level that they view as acceptable? And, is that 4%? Is it 3%? They've been talking about it at 2%, and that may really make the next recession difficult to weather.
Yeah, absolutely. It's one thing to say 2% now, but when job losses start piling up and the economy starts slowing meaningfully, it'll be another thing to see where they ultimately get comfortable. I guess the big next question is what inflation that's persistent and sticky at these levels, combined with a potentially higher, terminal Fed funds rate, higher rates across the curve, what does that mean for equities and what does it mean for earnings? We just kind of concluded an earnings season that I would label as pretty mixed, maybe weak, but I don't think we've seen the full effect of those policy moves either. What's your outlook there?
Yeah, weak, mixed and weak is how I would think of it as well. And of course, that doesn't really get anybody to move one way or the other on the base case. Ultimately, the amount of monetary tightening that has been put into the system, both domestically and abroad, so even global operators have these challenges in other ports of call, has been, significant. And the lagged effects of that tightening is likely going to come home to roost toward the tail end of this year and into early 2024. If you just sort of use the traditional, 1.5 to 2 year type of time lag that these things tend to operate with. So, on the one hand, the higher levels of inflation through the money illusion make it seem as though everything is okay, but on the other, those increased costs sort of permeate the income statement. Labor, as in general, has remained pretty strong, but ultimately speaking, we do know that profit margins are under acute pressure across the board, meaning almost every sector and industry has been negatively impacted and has seen a decline in operating leverage. And unfortunately or not, one of the things that doesn't seem to be as appreciated by investors is that companies can lay off a lot of people very quickly. It's sort of the lever that they have to, quote, catch up and sort of right size the business to the operating environment. And so I guess it's a concern we have that the longer things seem as though they're okay, even though under the hood they may be out of balance, the greater, as we talked about earlier, the pain may be felt. Specifically to earnings, Ross, I think one of the things we need to consider is that, in a traditional recession-related decline of corporate profits, you would tend to see those levels come in by 20%. That would be the median. 30% would be the average, even if that's slightly inflated by the financial crisis. And right now, the prevailing estimates from the street for profitability this year, 2023, are really looking for earnings to be flat. And that just seems too optimistic given the pressures that operating companies are under.
Right, and you mentioned that it's, especially on the margin side of the table, it's basically every industry or every sector across the board. So I guess it begs the question, in an environment like you're talking about that should be challenged going forward, where are you all hiding out? Where are the ports in the storm? What sectors do you like in this sort of complex environment?
Yeah, as you know from our work, we like to think of the world thematically, and what we deem to be a slightly counter trend move in equities right now has put us a little bit back on our heels with the way we're looking at the world. But thematically, we still believe really much in this idea of recession protection and focusing on companies that have very strong cash flow profiles. Companies only have so many things that they can do with their money, but having it provides optionality, and whether that's reinvesting back in their business or saving it for a rainy day, having it is better than not having it. So in an environment where we see growth slowing, we want to focus on what we call cash flow aristocrats and companies that might, companies that might provide some recession protection. So those would be two themes that I actually think could find some asset growth invested in them as we move through the year. And then, the other two themes that are really dominant in our work right now, where we think there is some thematic momentum and where prices have supported the conclusion more recently, are really taking into consideration what's happening globally. It seems as though we are increasingly in a polarized world. You and I have talked about deglobalization on this and in other formats many times, and that seems to be very much a part of the consideration for global operators, as well as sovereign states, sort of shoring up their access to resources across the spectrum. So deglobalization is one, particularly on the supply chain side and the access to industrial resources that we would focus on. And then lastly, which is an area that sort of is super ripe for investment, is energy security. Energy is not a new story. The sector's done quite well over the last couple of years, but it remains underloved in terms of its inclusion in client portfolios. We think there's a lot of fundamental rationale for thinking about increasing exposure to the energy space, both domestically and abroad, as we move into and through this economy right now.
Yeah, and I appreciate that. I think it's a really unique and interesting way to think about asset allocation versus some of your more traditional sector frameworks. So thank you so much for the time. I think this has been really useful and hopefully actionable for our clients and advisors, and can't wait to talk to you again soon.
Looking forward to it, Ross. Thanks, bud.